We're lucky to be joined by Liz Young, the head of investment strategy at SoFi. She's a regular on CNBC, other places. She puts out a lot of great content on her Twitter page as well, so I would recommend you go and give her a follow. But how are you doing, Liz? We appreciate you joining us.
Hi there. Yeah, thank you for having me. I'm happy to be here.
Awesome. Well, I know our time is a little bit limited here, so I would love to jump right into it. I would love to kind of hear your thoughts on how this market has been going. Obviously, big tech has been leading the way, and that leadership has been pretty narrow. Today, it's a little bit of a pullback, but one day is not a trend in there. I would love to kind of get your thoughts on big tech, in general, the market, QQQ. We're at the end of the month right now, and it's very, very strongly outperforming SPY this past month. I would love to hear your thoughts on the market right now.
Yeah, well, I mean, you rightfully point out that the leadership is incredibly narrow to the point where all of the upside has really been dependent on 5 to 10 names in the S&P 500. And if you look at the equal weighted index, or maybe you've heard people say the average stock. So if you take the equal weighted S&P and compare that to the market cap weighted S&P, they're at a spread of, I think, about 10 percentage points right now, year to date, with the equal weighted index actually down a little bit on the year. So there's very narrow leadership, and generally my thoughts on that are that it's a fragile rally, in the sense that, I usually think of it as some kind of sports team. If you've got a basketball team on the court and one star player, and the entire team depends on that one star player, and he sprains his ankle, you're in trouble, right? And if you don't have the 4 other players to really pick up the slack. So we're in a place right now where the narrow leadership, I think, is maybe making investors nervous, and is probably presenting the risk of some inflated valuations in particular names. And I can't talk about specific names, but inflated valuations and maybe enthusiasm that's gotten pretty far ahead of itself just in the short term. But that being said, I want to acknowledge the fact that there are obviously buyers in this market. And I think it's been astounding to a lot of people, and professional investors maybe especially. It's been astounding too, because the environment otherwise, the macro environment and the monetary tightening environment and the inflation environment, and you name it, right? There's a lot of signals out there that are telling us to be cautious. There's just been still some relentless buying appetite, particularly in those tech names. So I think this market is kind of stuck between a lot of people who want it to be the new bull market, and other people who are saying it just can't possibly be that way. And we're sort of having a tug of war until we decidedly move one direction or the other.
Yeah, that makes a lot of sense. There has been so much signal in this market over the last couple of days and weeks. We've had AI, we've had the Fed, we've had the debt ceiling. It feels like the debt ceiling is coming to a head here. I kind of want to ask you your thoughts on that. It kind of felt like the market never really took it seriously. The market really was never moving off of those headlines. We had a fake explosion at the Capitol AI image come out, and that moved the market more than any other debt ceiling headline that we've had. So I would love to get your thoughts on where we're at right now, and kind of if you think the market really ever took the threat of us not coming to a deal seriously.
I don't think that the equity market took it very seriously, or at least in the sense of, I don't think the equity market priced in a realistic possibility of a default and what that would look like if it had to ripple across, which I think ended up being the risk coming into this. And to be fair, it hasn't been entirely resolved, right? It still has to pass Congress, but all signs are looking like it's going to work out, which is a good thing. And I think it's a good thing that we didn't get to the 11th hour and, we're waiting on a Sunday night to see if we're going to default at 8 a.m. Monday morning. And I think it's a good thing that we didn't have that experience, and hopefully we won't end up with that experience. But I don't think the equity markets priced in the real possibility of a default and of Congress not actually coming to an agreement. The interesting thing was that if you looked at credit default swaps of treasuries on the real short-term instruments, so maybe a 1 month or a 3 month, those did actually increase quite a bit. They had a huge spike in cost, meaning that it cost more to buy protection on treasury securities in the last month or so. So there was obviously some consternation by some investors, and obviously somebody bought these CDSs and was worried that a default was at least a non-zero probability. I don't know that anybody realistically thought that the U.S. would default and kind of fall off into some sort of abyss from a treasury perspective. But the chance of there being volatility and just something else that we would have to layer on top of this market where we're all still sort of looking around the corner for, are we okay? I think that was the part that was the risky scenario. So there's definitely a possibility that if and when we get final closure on it and we know that it's passed and we've sort of averted disaster for the time being, that you get a pop in the stock market. You know, I think because it wasn't entirely priced in that things would go poorly, that maybe limits the upside in a pop, because I think the market had sort of assumed that we were going to figure it out one way or another. So there may not be a ton of upside in that particular circumstance, but you may see a little bit of a pop in general.
Yeah, that makes sense. Stock Talk, you have a question?
Hey Liz, great having you here. I know you tweeted, I think it was probably about a week ago, about your view on the resilience of the labor market, based on last week's initial jobless claims. Did today's JOLTS data maybe shift your opinion a little bit? Are you looking into the second half of the year, for the labor picture to shift? What are your thoughts on employment in general, so far this year and headed into the second half of the year?
Yeah, thanks for the question. So the labor market has been one of the pieces that I think continues to perplex macro strategists. I would put myself in that bucket on some degree, especially with the labor market. So the JOLTS data today surprised to the upside, meaning there were more job openings than we expected there to be, or what estimates had expected there to be, which further reinforces the idea that the labor market is just incredibly tight, right? More jobs open than there are people to fill them, and we carry forward in this same fashion. There are a couple things, as with any data point, under the surface that are always important to note, and you always want to note the market reaction to that data as soon as it's printed. So what happened today was the JOLTS data got printed, surprised to the upside with more openings, and yields spiked a little bit, but it was like a very, very tiny spike. And then they sort of came back down. And our speculation on why that happened and why the spike was limited is because you saw a pretty low quits rate. So embedded in that JOLTS data is a measurement of how often or how willing employees are to voluntarily quit their job. And if you just think about that from a common sense perspective, somebody's not going to quit their job unless they feel pretty confident that they either can find another one, or maybe they already have one that is paying more, or some other thing, right? That's pretty much a display of confidence in their own employment situation. So the quits rate was quite low. And if you watch the relationship, and I did post this as a chart on Twitter this morning as well, so you can check that out. But the relationship between the quits rate and wage inflation is pretty tight usually. So if the quits rate comes down, you typically see wage inflation follow suit. So you might be saying, well, that's a good thing, right? We need inflation to come down. Well, we do, yes, but wage inflation hadn't really kept up with actual inflation. And that was the pinch that many consumers were feeling. So there were some things under the surface of today's report. There's always the headline, and then there's the rest of it. As far as last week, the initial jobless claims, some of it got revised because there was fraud that occurred in Massachusetts. So there was an increase in jobless claims that made the overall data look like it had spiked up or had been climbing pretty meaningfully. And then they revised it because a lot of those claims turned out to be fraudulent in Massachusetts. So there was a little bit of a rejiggering last week with the data. The labor market has gotten, I would say, incrementally weaker. I prefer actually to look at continuing claims rather than initial jobless claims. Continuing claims just give a little better read on, how long people have been unemployed and how sticky that might be. Typically, you see a very gradual rise in both initial and continuing claims until you might see a spike. And we heard a lot of headlines at the end of last year and into the beginning of this year about tech layoffs. And the reality of that was they felt very dramatic and it all sounded very dramatic in the headlines, but tech doesn't make up a large enough portion of the labor force to show up in this particular data set. And the piece that I think is yet to show up and may slowly come about is small and mid-sized businesses. So small and mid-sized businesses make up, I believe, somewhere between 70 and 80% of the overall labor force. And what's happening right now, again, under the surface to small and mid-sized businesses is credit has tightened. And what I mean is first of all, there's a difference between credit tightening and credit deteriorating. So credit has tightened in the sense that it's been more difficult for small businesses to get loans or to get financing. And if they can't get that financing, they can't finance their operations, they may have to engage in layoffs and so on and so forth to save costs. It's not that they can't get the financing because somehow they've become a bad business overnight. It's because maybe their interest coverage ratios don't work out anymore at this level of rates. And certain banks and financial institutions have pulled back and tightened their lending standards just to manage their own risk. So there's not as much money available to small and mid-sized businesses, and that's sort of something that's being talked about under the surface, but hasn't hit the mainstream quite yet. And I suspect that over time, that shortage of credit to those businesses will impact the actual labor numbers. Sorry, that was a very long answer, but I wanted to make sure I got through it all.
Stephen, I saw you unmute there quickly. Have anything you want to add into that or a question off that?
Yeah, no, Liz, I think that's a great point. Are we actually seeing it in lending metrics? Are we seeing that tightening already? Because I know people were looking at some lending data a few weeks back and saying maybe the Fed didn't get what they wanted here. Lending is still fine. So what are you seeing from lending data, and what lending data do we even look at to kind of gauge this?
Yeah, so it's a good question. So if you're looking at consumer lending data, I don't think it's showing up there yet. What shows up, there's lending data, and then there's credit data. And when I say credit, if we're talking about the consumer, you want to look at things like days delinquent, something like that. And one of the things that is happening, and again, it's like it happens piece by piece, very, very little pieces at a time. So if you remember at the end of 2022, there started to be some headlines and some chatter about this increase in credit card debt. And the level of credit card debt that consumers were carrying had risen. And I remember thinking, and I was certainly not the only one thinking this, that, well, if consumers have all of this savings pent up that we keep hearing about, and they're just sitting on it, waiting to spend it, then why are they increasing their credit card balances and not paying them off every month? Something about that just doesn't quite track. So when you have data sets like that that don't mesh with each other, you have to wonder what else could be going on under the surface. I think what probably occurred is that you had higher income people were the ones with most of the savings, and lower income were the ones spending on credit cards. So what's happened over the last month or so in the credit market for consumers is that you're seeing the delinquencies start to lengthen out. Now, it's not at a level that's problematic. It's not anywhere near where it was, in the financial crisis, nothing like that. So I don't want to scare anybody. But there's this slow uptick in the rate of delinquencies. And usually the most problematic time is when you see those delinquencies extend beyond 90 days, because that's usually when the consumer either doesn't pay it at all, there's no recouping that loan, and you're seeing some increase in that. So that's how you watch it from a consumer perspective. If you're looking at banks and saying how much are they lending to consumers in personal loans, that's been a pretty good business lately. So you might not see it in that data. Where you do see it on the small business side is there are surveys that are done of small businesses, and they answer questions like, we have found it harder, equal, or easier to get money now compared to 1 year ago. And what's happened is you're hearing more and more small businesses respond to surveys like that and say it's harder to get financing. It's harder to get credit from banks.
And that's from the SBA, like the Small Business Association puts that out?
I believe it's from the SBA. I'd have to confirm that. And you're also hearing it from banks themselves, right? Whether it's in earnings calls or otherwise, you're hearing them say that they've tightened their lending standards. And they're doing that some of it perhaps in response to what happened in March with the regional bank crisis and sort of what went on in that period, but also some of it due to the sort of liquidity issue that is universal throughout the system. And if these banks are trying to meet certain regulatory standards and they've got a bunch of losses built up on the balance sheet, or they've got concerns about liquidity, or whatever the case may be, you're just hearing banks talk about tightening their lending standards. So I think that's probably going to continue. And then, add on top of that, this sort of hum about commercial real estate defaults and that issue, right? And the interlinkings between commercial real estate and regional banks. So there's a lot of things going on in the lending community and in the lending numbers that I don't think we've quite seen come through in what we hear about in headlines.
That's awesome, Liz. If I could just do a follow-up on this. I feel like the Fed has to be watching this lending data as close as anything right now. And I just worry that it's easy to say, oh, lending's still fine, that's a good thing. But does it become a situation where good news is actually bad news, in a sense where, what if the Fed looks at this lending data and says, it hasn't come in as much as we thought it would? Okay, that means we got to hike more. And couldn't that be worse than if lending actually did just come down materially enough to back them off of hiking?
Well, I mean, I guess the real short answer to that question is the Fed's going to get what they want, like full stop, right? And if they want there to be less money sloshing around in the system, they'll have to keep hiking rates in order to achieve that result. The hard part is it's not necessarily lending that they're probably watching for the indication of whether or not it's working. And there's been a huge shift over the last week even. If we pull it back 2 weeks, it's been an even bigger shift in what the market expects for rate hikes and rate cuts. And if you remember back in March and April, there was actually, I think we got up to 4 cuts priced in before the end of the year. Even just a week ago, we had less than a 20% chance of a hike at the June meeting. And now we're above a 60% chance of a hike at the June meeting. And one cut, not even one full cut priced in. So that part of the market moves very quickly on what it expects the Fed to do. I think the Fed watches that and knows it. My personal opinion is that Jerome Powell does not like to surprise the market, and he values flexibility. So that's what we're going to continue hearing. I would expect from them that they're going to telegraph it pretty clearly what we should expect to happen at each meeting, and the market can get pretty close to what that expectation is. And that's been the experience for the most part. The part that gets kind of hairy from here on out is that there haven't been any dissents on the FOMC as of yet in this hiking cycle. So you're starting to hear Fed speak where you got one person that comes out and sounds really hawkish and one person that comes out and sounds more dovish, and then there's a smattering of everybody in between. I think we're going to start having FOMC meetings and statements that indicate dissenters. It won't be a unanimous vote anymore, in which case the market starts to have a really hard time trying to figure out what the Fed's going to do. Because at what point, what if it starts being split 50-50? Then Jerome Powell has veto power, perhaps, but is he really willing to go against half of the FOMC, right? So I think it's going to get a little dicier as we get maybe beyond June, and there's sort of this guessing game about what could actually happen. But like I said at the beginning of this answer, I think the Fed is going to get what they want either way. And I was of the mind that I thought they should pause in June, and the market is now, it's seemingly okay with another hike. So they may keep hiking until they really, really can't anymore, and that would probably require something else to look bad, right? Some other data set to look bad.
Or another bank to go, right?
Or, well,
That might not be enough.
I mean, logically that sounds like a possibility, but they kept hiking through everything that already happened.
They didn't seem to care, and you could argue that they knew about Silicon Valley Bank well before it happened.
Perhaps. I mean, and that all felt pretty dramatic, right? And there was a Fed meeting not long after that, and they chose to go ahead with it. So, maybe it's a larger bank. I mean, what you've seen in the past is the Fed stepping in and changing its tune when capital markets stop functioning the way that they are supposed to. And perhaps what happened in March and April, although painful and scary for a lot of different businesses and a lot of investors and consumers, it was scary for, I think, everybody because it happened so swiftly. But perhaps their read of that was that capital markets were still functioning properly. If something should happen, let's say there's a bigger thing that happens, and I don't know what that bigger thing would be. It may not even have to be in the banking industry. It could be a completely different industry. Who knows? But if it's something bigger that causes markets to not react properly, that's when you start to see them step in and do something unexpected or do something in a reverse direction that it's sort of their hands are tied. And that has not happened.
I kind of want to ask you the question here. What do you think? You definitely can say I don't know or whatever. But what do you think Jerome Powell should/will do and the Fed at this June 14th meeting? Do you think we kind of get a pause and see how all these effects are, and we'll see if we're going to raise at the next meeting, or do you think they're going to go that 25 basis points here?
Oh boy, it's
we still have CPI, we still have more jobs data coming, so 100% can say I need to see that data.
Well, and I think somebody double check me on this. I think CPI comes out the Tuesday of the Fed, so the day that the Fed meeting begins.
Yeah.
And then they announce the next day. So what that means in my head is that they get a heads up. They're going to get a heads up on CPI probably before the meeting starts. And he actually has admitted that in a press conference, that if there's a really important data point that's going to come out during our meeting, he does usually get a heads up. So chances are he gets a heads up on Monday about CPI, or at least Tuesday morning before the meeting begins. And it's possible, I think it's very possible, that CPI does not come down a ton. I also think there's a non-zero possibility that it actually goes up a little bit. So what we saw last time in the read was that services inflation, the services component of CPI, and what the Fed would call the super core, came down quite a bit. And that was a really good sign. I actually wrote a blog post and outlined that and said, you know what, I've been pretty cautious and bearish, and this was actually a pretty good CPI number because of what happened under the surface. And I will acknowledge that this was moving in the right direction, but it was just 1 month, right? So we need to see, I would say 3 months of that before they might feel comfortable saying, you know what, we're good. We're gonna stop and be done with it. I guess in the current environment, I would say the likelihood is probably that we see another 25. And most of the reason that I say that is because Jerome Powell has committed so many times to not repeating the stop and start cycle that happened in the 1970s. And I think that he's going to stay committed to that. So the idea of them pausing but leaving the door open to another hike later, I think would qualify as a stop and start cycle. So, and he also from the get-go had said we'd rather go a little bit too far, go really hard at it out of the gates, and then we have the tools to sort of back up the train if we have to. So I think they're still going to err on the side of maybe a little too far. So if we're at that decision point, we're on the fence of is another 25 basis points too far? I think they probably err on the too far side.
Yeah, that would go with what Jerome Powell has been saying a bunch and going to the whole theme of not wanting to shock the market. I know we got about 5 minutes left of your time here and definitely do want to respect that. So everyone down below, if you have enjoyed this, make sure you go in and follow Liz. I want to slide in one more question in here at least and throw it over to Jaguar for that one.
Hi, guys. Thanks for having me here and be able to catch Liz here from SoFi. I'm not sure, Liz, how much you can comment on SoFi specifically in the spaces, but I do have one.
I don't think we talk about stocks, individual stocks at all, right?
Right. I can't do individual stocks, more like and I can't talk about the company results or anything of that nature.
I understand. How about just a general sense so we can all just be more informed that we know that the student loan moratorium ending, whether it is done by the Supreme Court or it is done as part of this debt ceiling resolution with the vote that is actually taking place right now, it's been pretty much out on the street quite a bit that it will be net quite positive for SoFi. Just wanted to hear your thoughts on that, if you can, and if you can, don't worry about it. Just wanted to ask that question.
Yeah, unfortunately, I have to steer clear of that one. I hate to say that to you, but PR, legal, and compliance limit me on what I can talk about with the
Def-
company.
No
we have
problem.
seen the
Thank you.
compliance
Yeah.
100%. I have definitely been working with some of the stuff, and it is craziness. I do want to ask you kind of slide one more question here. The hype of this year has been AI. It has been going crazy. Nvidia stock was flying last week. It's pulled back a tiny bit today, but still past that $1 trillion market cap. I would love to get your thoughts on the AI theme, both kind of short term and then also long term, because it feels like there is definitely some different thoughts that can be had there.
Yeah, so the AI, I mean, first of all, nothing short of amazing of what's happened to a lot of the stocks that are tied to it and the move that's occurred. Some of the things that I think investors should keep in mind. I mean, first of all, I think AI is definitely has the possibility to be transformational across a lot of industries. And if it's something that happens over a number of years, it may even end up creating jobs. It probably will hurt some other jobs, but if it happens slowly and with time, it could end up creating jobs as well. So there's sort of this mixed bag of the economic impact it could have. The thing I would think about as an investor is that the enthusiasm around it has been something that's happened in relatively short order in the stock market. So if you just think, even if we just say it's been year to date, you've seen these huge run-ups in stocks that are talking about AI or that are going to be a bigger part of AI. I mean, triple digit run-ups, and to valuations that could be justified if the best case scenario comes true. The valuations, though, I mean, a lot of times we talk about valuations on a forward 12-month basis. So be careful thinking about, if this is what I'm going to pay for this stock today, do I think I'm going to get gratification on this valuation in the next 12 months? And I think the AI movement and just the uptick of it is going to take a 5 to 10 years, right? So you may not get gratification on that particular valuation and what you would pay for it after a big run up like this. And anytime you have a new technology or something that is transformational, some people might even put crypto into that bucket, right? Anytime you have a new technology or something that's transformational, there's a life cycle to it, and that life cycle, especially on the early side, is going to include somewhat of a boom and bust cycle. And there's going to be companies that do it really well, and there's going to be companies that don't end up keeping up or don't do it really well. So it's a difficult theme to buy broadly right now. And I think the enthusiasm is warranted, but I would be careful not to be too short-term oriented on when you're going to get the satisfaction of saying, okay, it was worth it to buy that stock at that valuation, because I think it might take a little longer.